Joining us now to talk markets is Jeremy Siegel. He is professor emeritus of finance at the University of Pennsylvania's Wharton School of Business, also the chief economist at Wisdom Tree. And Professor, thank you for being here this morning. We've been kind of talking through what the Fed might do next based on those FOMC minutes that we got yesterday. It does not look like there's a clear consensus at this point. It does not look like Chairman Powell will necessarily be able to drive things the way he may want. And I guess you're someone who has been in favor of more rate cuts. Why don't you lay out your case for it? Because the data that we've seen recently doesn't really play into that. If you're looking at the jobs market, even if you're looking at what Bank of America's Institute told us this morning about the consumer based on the 69 million accounts that they have for consumers and small businesses, things look better than you might have anticipated just a month or two ago.
Yeah, I think for everybody, including Fed, it looks better. But I still believe, and the Fed believes, that we are still way in restrictive territory. Remember, they said the long-term Fed funds rate they want to go to is 2.9. That's 2 percentage points below where we are today. Now, I actually think it's higher. I think it's probably 3.5, where we will eventually go to. When I just looked at the Fed funds markets, when I backed out risk premiums, it looks like about 4 more cuts to the middle of next year, which means maybe alternate 25 basis points and a pause. But let me say the following: some people say, "Oh, we should stop now. Things are great." I think that's very dangerous. First of all, if you think that the Fed funds rate is at the right level now, which is right very near 5%, then that means that the 10-year is going to 6%. And mortgage rates 30-year fixed mortgages are going to go to 7.5%. And I don't think that the market is expecting that. So I think when you take a look at what the market is doing and saying is that, yeah, it's not as low as what the Fed says we're eventually going to go to, but it's still lower, much lower than we are today. Now we're going to get in a half an hour the CPI. I expect actually that the core rate might take a tenth higher on the month over month than expected. I still think 1/10 for the overall, which would, by the way, bring the year over year overall all the way back almost to the pre-pandemic levels. So, I mean, we are almost there on the inflation, and the market is telling us, we need to go further, 25, maybe pause 25. But by the middle of next year, I think we should have a 3 handle on the Fed funds rate.
A couple of things. First of all, year over year, you're still looking at anticipated CPI, the consumer price inflation of 3.2%. So that's still something to be a little concerned about. There are questions as to what a lot of things that we've seen recently will mean for the inflationary picture. You can talk about the hurricanes that have just hit. And then you've got issues about what happens when the ports come back in January. We've put off this strike for now. We'll see what happens to it. Got questions about what to expect from oil demand. What's wrong with the Fed saying, we're going to wait and see what happens over the next month or so?
Right. Well, the Fed should not react to supply shocks such as caused by the hurricane or caused by, any hostilities in the Mideast that raise the price of oil by, either keeping rates higher or raising rates.
Well, they got to react to inflation.
That would be doubly damaging, in my opinion, to the economy. Listen, we've had oil experts on that say that the oil prices have to be lower next year, that there's a lot of oil that could come online. I mean, we could talk about what potential if we take out Iran oil. Saudi Arabia has 2 million barrels that it said, well, we could bring that online. But supply shocks such as the hurricane, the dock workers, listen, if you can keep rates rising because groups oppose automation, I don't think that is the right place to be also. So, when we take a look at the whole picture of where the Fed thinks the neutral rate is, and by the way, I look back to when they started looking at neutral rates, which is way back in 2012, and if we stop now, we would be at the highest neutral rate, far higher than anything that they had proposed over the last 12 years. And no economic model says that we should stop now and that the neutral rate is as high as it is. And as I said, if it is that way, then we all need to be prepared for much higher long-term interest rates. I was the one that said that when the Fed was very aggressive, we would not see a drop in those long-term rates, we'd see a rise, because the Fed has taken recession risk off the table. I mean, not 100%, but largely off the table. And a lot of people buy that long bond as a hedge against recession. If the economy is going to be strong, long-term interest rates are going to be strong. They're going to go up. Everyone's that's waiting for the mortgage rates to go down. They're going to be very disappointed